Orders from the grave. The man is dead, the bombs already fell, the missiles already stopped him, but something is still moving, still firing, still executing, exactly as he planned, before they killed him. Khamenei left something behind. Not a message, not a farewell, a machine, one that runs without him, one that no one can turn off. Welcome to Currency Archive. If this is your first time here, you've arrived at exactly the right moment. And if you've been with us before, you already know. We don't do noise here. We do truth. Now, before we go further, if you're someone who still believes the real story makes it to mainstream news, hit that subscribe button. Think of it like this. You wouldn't let your morning newspaper disappear, would you? This channel is that newspaper. Don't let it disappear from your feed. And tell us in the comments, where in the world are you watching this from today? Because what's coming next affects every single one of you differently. On a Monday afternoon, inside one of the most secure rooms in the world, the President of the United States asked a question. It was not a complicated question. It was not a question about military strategy or nuclear capability or how many missiles Iran had left in its arsenal. It was simpler than all of that, far simpler. And precisely because of its simplicity, it exposed something that no intelligence report, no satellite image, and no diplomatic briefing had been able to reveal until that exact moment. The question was this: who do we call to stop this? Not which general, not which ministry, not which faction inside Tehran held the most power after the strikes. Just who? What number? What channel? What name? The room went silent. Not for a moment. Not for the brief pause of someone organizing their thoughts. The silence lasted several seconds. And in those several seconds, every person sitting in that room, people who had spent decades studying Iran, tracking its leadership, mapping its power structures, had no answer to give. That silence told the entire story. To understand why that silence happened, one must go back not to the morning of the strikes, but to the months before them. Khamenei had been watching. He had been watching what happened to Saddam Hussein. He had been watching what happened to Muammar Gaddafi. He had been watching what happened to every leader who built a system of power that was centered entirely on one man, and what happened to that system the moment that man was removed. He studied those collapses carefully, and he made a decision. He decided that his death would not be a lever. It would not be the moment when the machine stopped running. It would not be the event that gave America or Israel or any outside power the ability to pick up a phone, find the right person, and negotiate an end to what Iran had set in motion. He spent his final months making sure of it. To understand what Khamenei built in those months was not a succession plan in the traditional sense. Most leaders, when they feel their mortality approaching, focus on who will replace them. They focus on names, on loyalty, on which trusted figure will sit in their chair and carry their legacy forward. Khamenei focused on something entirely different. He focused on making the chair irrelevant. The system he constructed was deliberately decentralized. Targeting authority was not held by one commander or one council or one body that could be identified, isolated, and pressured into standing down. It was distributed, spread across hundreds of units, each unit with its own pre-assigned mission. Each mission authorized before the bombs fell. Each unit requiring no further instruction from any surviving commander to continue executing exactly what it had been told to execute. This was not improvisation under pressure. This was not Iran adapting in real time to the shock of losing its supreme leader. This was architecture, carefully designed, carefully implemented, and carefully stress-tested in the 9 months between the June 2025 ceasefire and the February strikes. The European Council on Foreign Relations, in an analysis released the morning after the strikes, described what they observed in precise terms. Iran, they wrote, had pivoted to a decentralized system specifically designed for wartime conditions. A system built to absorb American bombing. A system built to demonstrate unity, command, and control, not despite Khamenei's death, but through a structure he had specifically engineered to function without him. Those words deserve to be read slowly by every serious business mind, every entrepreneur, every decision-maker who believes that removing a leader removes the threat. The threat was never the man. The threat was what the man built. And what he built is still running. Right now, as markets open, as tankers reroute, as insurance premiums climb, and as the Strait of Hormuz remains conditionally closed, the machine Khamenei designed before his death is executing precisely as he instructed. The chair is empty. The machine does not care. There's an old engineering principle that the most dangerous systems are not the ones that require constant human attention to function. The most dangerous systems are the ones specifically designed to operate without it. Khamenei understood this principle, not as an engineer, but as a man who had watched for decades how America dismantled threats. He had observed the pattern with surgical precision: find the leader, remove the leader, watch the system collapse, then walk in and reshape what remains. He decided, sometime in the months before his death, that Iran would not follow that pattern. What came next was not reactive. It was not desperate. It was the most deliberate institutional restructuring any regional power had attempted in the modern era, executed quietly, documented carefully, and completed before the first American strike ever reached Iranian soil. To understand what Khamenei built, one must first understand what he dismantled. For decades, Iran's military power operated on a model familiar to any student of authoritarian governance. Authority flowed downward from a single point. The supreme leader held ultimate command. The Islamic Revolutionary Guard Corps reported upward. Regional commanders reported upward. Every significant military decision, every authorization to escalate, every order to stand down, it all passed through a centralized structure with one man at its apex. That structure had a vulnerability so obvious that American strategic planners had built entire contingency scenarios around it. Remove the apex. The structure loses its nervous system. Confusion spreads downward. Units hesitate. Commanders wait for orders that never come. The machine stalls. Khamenei knew this was exactly what his enemies were planning. So he removed the vulnerability himself. Beginning in the months following the June 2025 ceasefire, Iranian military doctrine underwent a transformation that Western intelligence agencies were tracking in fragments, but never assembling into a complete picture until it was too late. The IRGC was reorganized, not visibly, not in ways that generated headlines or diplomatic protests, but structurally, at the operational level, the chain of command was deliberately fractured into autonomous cells. Each cell was assigned specific targets. Each cell was given specific trigger conditions, environmental signals that would automatically authorize action without requiring any communication from above. No phone call needed, no confirmation required, no living commander necessary. The trigger conditions themselves were elegant in their simplicity. If certain thresholds were crossed, American strike packages of a defined scale, Israeli operations beyond a defined geographic boundary, specific movements of naval assets in the Gulf, the authorization was considered automatically granted, pre-signed, pre-sealed, issued by a man who knew he might not be alive to deliver the order in real time. This is what military analysts mean when they use the phrase pre-authorized orders. It does not mean a recorded message. It does not mean a letter opened after death. It means a command structure where the decision has already been made, already been distributed, and already been embedded into the operational DNA of every unit that received it. The doctrine shift went further than targeting authority alone. Since the June 2025 war, Iran formally moved from a defensive containment posture to what analysts now describe as an explicitly offensive asymmetric posture. The language matters here. Formally, not informally, not as battlefield improvisation. Formally, meaning written into doctrine, institutionalized into training, embedded into every level of the military hierarchy. Regional missiles, drones, cyber operations, energy infrastructure attacks. These were no longer last resorts. They became first instruments. The doctrine said so explicitly. For every entrepreneur and business strategist reading the current situation as a temporary disruption, a conflict that will de-escalate once diplomacy finds its footing, this doctrinal shift carries a specific and uncomfortable message. This was not designed to end quickly. The attacks on Gulf energy infrastructure, the strikes on American forward bases, the targeting of commercial towers in Dubai, none of these were improvised responses to battlefield pressure. They were scheduled, assigned months earlier to specific units operating on specific timelines with specific pre-authorized mandates. The machine was not activated by Khamenei's death. It was already running before he died. His death simply removed the only switch that could have turned it off. There's a body of water that is 21 miles wide at its narrowest point. 21 miles. A person can drive that distance in less than 30 minutes on an empty highway. It is, by almost any geographic measure, unremarkable. A thin corridor of blue between two coastlines, easy to miss on a map if one is not looking carefully. But every morning, when oil traders in London open their terminals, when shipping executives in Singapore calculate their routing costs, when fuel procurement officers for every major airline on Earth finalize their quarterly forecasts, that 21-mile stretch of water is the first number they check, the Strait of Hormuz. Approximately 20% of the world's total oil supply passes through it daily, not weekly, daily. Every tanker that does not pass through that corridor on schedule does not simply represent delayed cargo. It represents a cascading sequence of economic consequences that touches fuel prices, manufacturing costs, food transportation, airline ticket pricing, and the quarterly earnings of companies that have never once mentioned Iran in any public statement. Khamenei knew this. He had known it for decades. And in the machine he built before his death, the Strait was not a bargaining chip. It was a trigger. Since the conditional closure was announced on day one of the current conflict, the word conditional has done enormous work in financial press coverage. Analysts have leaned on it heavily. Conditional closure, they repeat, implies negotiation is possible, implies a threshold exists. Implies that if certain demands are met, the tankers resume, the insurance premiums normalize, and the supply chain disruption becomes a historical footnote rather than a structural reality. What those analysts have not fully priced into their models is the architectural fact established in Part 2. There is no single authority to negotiate with. The conditional closure was not announced by one man who can be called, pressured, incentivized, or replaced by someone more cooperative. It was embedded into the operational mandate of dozens of autonomous units, each operating on pre-authorized orders, each with its own trigger conditions, each requiring no living commander to maintain or escalate the closure. This means the negotiation problem is not diplomatic. It is mechanical. One does not negotiate with a machine by finding the right person to speak to. One negotiates with a machine by understanding exactly how it was programmed. And that understanding, as of this writing, does not exist in any Western diplomatic or intelligence framework currently deployed. The economic consequences are already visible to anyone willing to read the data without the filter of optimism. Shipping insurance premiums for vessels transiting the Gulf have climbed to levels not seen since the peak of the tanker wars in the 1980s. Rerouting around the Cape of Good Hope adds approximately 14 days to the delivery timeline for any cargo previously moving through the Strait. 14 days multiplied across the volume of global energy trade does not produce a minor inconvenience. It produces a structural repricing of every cost that energy touches, which is, in practical terms, every cost in the global economy. Jet fuel, diesel, industrial heating, petrochemical feedstocks for plastics, fertilizers, and pharmaceuticals. Every industry that uses these inputs is currently recalculating. Every procurement officer who locked in contracts based on pre-conflict pricing is currently absorbing losses that were not in any 2025 budget model. And this is before accounting for what is happening to Gulf energy infrastructure directly. The IRGC units targeting refineries, pumping stations, and offshore platforms across the Gulf are not operating randomly. Their target selection follows a logic that any serious business strategist will recognize immediately. They are not trying to destroy production capacity permanently. Permanent destruction invites the kind of international response that complicates the broader strategic picture. They're creating uncertainty. Uncertainty about whether a facility will be operational tomorrow. Uncertainty about whether a shipping lane will be clear next week. Uncertainty about whether a supply contract signed 6 months ago will be honored 6 months from now. In economic warfare, uncertainty is more powerful than destruction. Destruction has a defined cost that markets can price. Uncertainty has no ceiling. The precious metals market understood this before the oil analysts did. Gold crossed $5,400 per ounce, not because investors panicked. Panic produces sharp spikes, followed by rapid corrections. What happened in gold was different. It was a slow, deliberate, institutional repositioning, the kind that happens when large pools of capital conclude that a situation is not temporary. Silver followed with its own signal. The premium between Eastern physical markets and Western paper markets widened to levels that have historically preceded major structural repricing events. Shanghai was not reacting to the same news cycle that Western traders were reading. Shanghai was reading the machine. For every entrepreneur and business leader currently treating this conflict as background noise, something to monitor but not act upon, the Strait of Hormuz carries a specific message. The economic weapon Khamenei built was never named in any press conference. It was never described in any sanctions package. It was never the subject of any diplomatic negotiation. It was built quietly, embedded carefully, and it is now operating exactly as designed, not as a military instrument alone, but as a precision economic tool targeting the one vulnerability that every modern business shares, regardless of its industry, its geography, or its size. Its dependence on a world where supply chains function predictably. That world is being repriced, right now, in real time. In Part 4, the story moves to what smart money already knew, and when they knew it, and what the gap between Eastern and Western market pricing is now telling every serious decision maker who is willing to listen. There's a particular kind of knowledge that never appears in newspapers. It does not get announced in press conferences. It does not surface in analyst reports published for general consumption. It does not trend on financial news platforms or generate the kind of headline that reaches the average investor scrolling through their morning feed. It moves differently, quietly, through the kind of channels that require decades of relationship building to access, through conversations that happen in private dining rooms in Zurich, in closed-door meetings in Singapore, in the carefully worded correspondence between sovereign wealth fund managers who have learned, through hard experience, that the most valuable information is the information that arrives before everyone else receives it. That knowledge had a name in the months before the February strikes. It was called positioning, and the positioning had already begun long before the first bomb fell. To understand what smart money knew, one must first understand how institutional capital behaves when it receives a signal that retail investors have not yet processed. It does not react. Reaction is what uninformed capital does. Uninformed capital watches an event unfold on a news screen, feels the emotional weight of the imagery, and makes a decision based on what it sees in that moment. That decision is almost always late. The price has already moved. The opportunity has already closed. The informed capital that moved weeks or months earlier is now sitting on gains that the reactive capital will spend the next quarter trying to recover. Institutional capital does not react. It anticipates. It reads the secondary signals, the ones that do not make headlines, but contain, for those trained to read them, more strategic information than any breaking news alert ever could. In the 9 months between the June 2025 ceasefire and the February 28th strikes, those secondary signals were speaking clearly to anyone positioned to hear them. The gold market spoke first. Beginning in the third quarter of 2025, institutional accumulation of physical gold accelerated in a pattern that veteran precious metals analysts described as unlike anything observed since the period preceding the 2008 financial crisis. It was not the accumulation pattern of retail investors responding to fear. Retail accumulation is erratic. It spikes on bad news days and retreats on calm ones. It follows the emotional rhythm of the news cycle. What happened in gold was different. It was steady, methodical, consistent across weeks and months regardless of what the daily news cycle was reporting. Large positions were being built quietly, systematically, by entities that do not need to justify their decisions to quarterly earnings calls or impatient shareholders. Sovereign wealth funds, central banks, family offices managing multi-generational capital. These were the buyers. By the time gold crossed $5,000 per ounce, the accumulation phase was largely complete. The entities that understood what was coming had already taken their positions. What the financial press described as a gold rally driven by geopolitical tension was, in more precise terms, the moment when the rest of the market finally caught up to where informed capital had been sitting for months. Silver told a more specific story. The divergence between Eastern and Western silver markets that began in late 2025 was not, as some Western analysts characterized it, a temporary anomaly driven by localized Chinese demand. It was a structural signal, one that required understanding both markets simultaneously to decode correctly. In Shanghai, physical silver premiums climbed to levels that reflected institutional conviction. Not speculation, not retail excitement, but the kind of deep, patient accumulation that occurs when large Eastern capital pools conclude that Western paper pricing has become fundamentally disconnected from physical reality. The COMEX in New York was pricing silver as a financial instrument, a tradable contract, a number on a screen that responds to algorithm-driven flows, margin calls, and the mechanical liquidation events that periodically shake retail participants out of their positions at precisely the wrong moment. Shanghai was pricing silver as something else entirely, as a physical asset in a world where physical assets were about to matter enormously. The premium gap between those two prices was not a trading opportunity for short-term speculators. It was a message, written in the language of capital flows, readable only to those who understood that Eastern institutional money had already concluded what Western analysts were still debating. The supply chain disruptions were not temporary. The energy repricing was not a spike. The structural shift in global trade routing was not a negotiating tactic. It was the new architecture of a world being redesigned by a machine that was still running. The behavior of specific COMEX participants in the weeks preceding the strikes added another layer of precision to this signal. Delivery data, the dry, technical record of which institutions are accepting physical silver rather than rolling their contracts forward, showed a pattern that experienced market observers immediately recognized. Major financial institutions, the kind whose names appear on every significant Wall Street transaction, were quietly stepping in to accept physical delivery during periods of price weakness. This behavior carries a specific meaning in precious metals markets. Institutions that believe a price decline is genuine and sustained do not accept physical delivery during that decline. They wait. They let the price fall further. They accumulate at lower levels. Institutions that accept physical delivery during a price drop are communicating something different. They are communicating that they do not believe the price weakness reflects fundamental reality. They are communicating that they consider the discounted price a gift, a temporary disconnection between paper markets and physical value that will eventually, inevitably correct. They were not panicking. They were shopping. For every entrepreneur, every business strategist, every serious decision maker reading the current market environment as noise to be filtered out until clarity returns, the behavior of smart money in the months preceding this conflict carries an uncomfortable but essential message. Clarity had already returned for them. The clarity arrived not through better news sources or faster information networks. It arrived through a disciplined framework for reading secondary signals, for understanding that markets do not simply react to events, they price the probability of events long before those events occur. And when institutional capital begins moving in one consistent direction across multiple asset classes simultaneously, that movement is itself the most reliable signal available. Gold knew, silver knew, the shipping insurance markets knew. The sovereign wealth funds repositioning away from Gulf exposed assets knew. They knew because they were reading the machine, not the man.